We're live.
Sweet.
Dude, what up? All right, guys. Welcome to saying Lucci taking over BTFD TV once again, which we do every Tuesday and Thursday these days. Myself here, Charlie Bathgate, along with Bryan Wiener. Say hello, Bryan.
Hello. Happy Thanksgiving week.
Taking a break from his leave raking duties.
I'm actually done leave raking.
Yeah.
I'm still thawing out from the game in Foxborough from the other night.
Yeah, I don't. We're not talking about that. We're not talking about that game.
We're not talking about that.
We're beyond that.
We're not going to talk about it beyond the fact that I stayed the whole time this time. That's it.
Oh, God.
All right. Sorry.
I shut off at halftime because I thought we were going to catch you guys, but whatever. It is what it is. All right. So a lot of things that I want to talk to you about today. We got like a half hour. This is our chance to talk without Lucci and Pete busting in on our conversations here. So let's jump right into it, man. I know, like, one of the things that I'm really interested in is you are just the different approaches you and Lucci take strategically and psychologically to trading, right? I mean, Lucci is like balls to the wall, risk out, out the wazoo, like as much as possible, and then you are extremely disciplined control, sort of quantitative, but you're not doing black box, black box or gray box trading or anything like that.
Right.
So, and now you're trading alongside Lucci, like in the same space, physical space. You guys are interacting a lot more. I know you're learning tape reading too. So he just came off of like a $700,000 month. How do you, as someone who has like your experience and your trading style, like how do you look at a guy like that who has swings like that? And what is that? How does that impact your approach on trading?
Well, I mean, you're talking about it's like an investment. He's investing on a really shorter time frame. He's trading options, but effectively in his head, he's just trading stock. Options allow him to build up a big stock position.
Right.
He's not trading options the way they were necessarily designed.
Which is kind of his advantage, right? I mean, he's like...
listen. He is... I mean, it's hard to explain, but... The advantage for him is that he can put on huge deltas. You can put on a huge stock position, and as the stock goes up, his delta, his stock position is accumulating more synthetically through these options. So his delta went from like a 30 delta up to a 60 delta, 70 delta, and that's when he kind of panicked when SPOOs were dropping down that day, and he got out of everything, kept selling.
When he jumped out of the
BAC. We're just talking about BAC. He had Goldman still riding for a little while. He had all those names.
Right.
I mean, listen. I mean I respect him more than other traders I've ever seen because of the huge position, and it's not hedged. See, like when you're a vol trader, if you're in the pit, you're a vol trader. You're hedged, so you kind of just want the stock to move. You don't care if it goes up or down as long as it moves. I mean, you don't want the stock to go up to the actual option that you have and just sit there because that's the worst case scenario. So what he could have done to stay in that position, and he keeps regretting that he got out.
Yeah, no, talk about that, man, because you were in the room.
He regrets every day. He come in, like, chat me. He's like, man, that could have been $1 million later on. That could have been $2 million. And it's like, if he just hedged it with BAC stock or sold XLF, dollar delta, means that. So you could hedge it in different ways. You could hedge any stock with an ETF to cancel out the systematic risk of the market going down and holding on to that position. So he could have hedged it in XLF, and what you do is you take the option, the quantity of options you had in BAC, multiply it by the stock price in BAC, and you come up with this huge number.
Right.
What you would do is take that huge number, you divide it by the XLF stock price, and you have how many shares you needed to sell in order to hedge your position in XLF. You hedge your BAC position in XLF. You could have done it in SPY as well. And why you would do that is because you access more liquidity in some ETFs that you do in BAC or whatever.
Right.
So that is one approach he could have done, and then all of a sudden he has a vol position. He has a correlated vol position, but he's able to hold on to that and gain P&L on the hedge. And Pete was doing the hedge pretty well. It's just hard for him because you have all these names. So what all he had to do really was, you have BAC, he had Morgan, he had JPM, he had Goldman. You calculate your dollar delta and you hedge it all in XLF. It might take like a couple different trades, but you're doing, the actual buying power is much lower in XLF too because it's a smaller price name. So you might have short sailed maybe 1 million shares, but your whole portfolio is hedged and you can trade out of it almost instantly because it's this ETF that trades millions and millions of times, shares a day. So anyway, if you had that vol position, now you're making money on the hedge as you're going down. The volatility in those options is going up because those stocks are puking. Those stocks going down, and you're making you're making money on the volatility. You're losing money in the actual delta in those options. The only thing he really looks at, but you're making money in the hedge of selling the XLF.
Right.
So once you realize, in the next day after you got out that everything's going back up, you buy the XLF back up, and your options, your hedge is off. It's not a vol position anymore. It's pure delta, and you're back onto the trade. And that's, so as a vol trader, you want the stock to go down and up and down and up, so your hedge makes money. In fact, you might get chopped up, and you might lose some decay in that option, but your hedge is gonna make money.
And you've talked about how it's been rough, like for vol traders. I mean, I don't know if it's all vol traders specifically for you, like because there hasn't been. Is it because there hasn't been as much action, lately going on, or like why has it been just like, scarce opportunities, for a trader with your style in the last month, 2 months?
Right. I mean, so there's volatility. Volatility's low, so there's not a lot of demand to actually trade, and there's not a lot of vol, meaning the change in the volatility. So volatility is kind of just plateaued. It might spike up if we dip down, but then it comes crashing back in.
Right.
So volatility traders want to trade the change in the volatility. This chop in the volatility is sizable enough to get in and out and make money. But when the S&P specifically the volatility is so low, around I think it's like a 12 vol or something like that, there's really no opportunity to make money on the change in volatility. What you have to do is put on a set position, and you have to be right about the terminal point of the stock once expiration hits. So I don't have a crystal ball. I don't know where it's going.
Right.
All I know is that if you buy S&P options, you hedge them, and we move a little bit, you actually maybe make some money. You can buy calls, sell stock, and the stock drifts up. If it's a high vol, then you lose money. If it's a low vol, then you actually make money because the volatility isn't really going down. The curve is so low on the call end, then you're actually going to make money. Now, you could sell puts and sell stock, and if it drifts down, then you make money on that because the put wing is higher. But generally, I mean, as we drift up, there's not a lot of buying and selling of the options, so it's kind of boring. Right. I kind of just market make wings a little bit. So and my approach is, I mean, when I market make wings, I take away.
When you say wings, you mean way out of the money options, right?
Yeah, I mean, I'm not going to get in my specific approach, but you know, when you're dealing with weeklies and you're trading things that are far out of the money, there's certain elements in options that don't really exist. Delta, Lucci can't put on a huge trade and expect to be a winner when he's trading far out of the money options because the delta is so low. The change in the option price isn't going to be. I mean, you have to have an extreme move in the stock.
Extreme event, right? Yeah. I mean, that was like the Citibank trade, right? It's got something huge in the underlying to make those out of the money options like really move.
Right. Either that, or all of a sudden there's this big demand and implied volatility spikes.
Right.
So, I mean, what I'm doing is different. I take away delta, I take away volatility, and I just trade around, kind of. His approach is balls. Like, I love it because he doesn't realize how scientific it or systematic it is. Like what he's looking for is, you know, a current topic is the sectors sector change or whatever they call it. But
Sector rotations.
yeah, sector rotations. See, that's not even like I'm not a Delta guy. I don't know about. I'm like learning from these guys. It's awesome because again the tape reading like I will know to hold on to a position because I studied like the tape reading and stuff like that. So
right. I think I just lost my feed for a second.
you did, and I thought it was me because I actually had computer problems this week. So I was like, mother f. I had to go call HP, and I'm in my parents' satellite office right now. It's very exciting. But the sector rotation, he was waiting for a sector rotation in the banks. He saw spiders going up. Banks should see that. I don't know what his catalyst was for thinking the banks have to go up, but he was right. He was so right. If he just hedged his position and at the right times, he would be able to withstand the option, the stock retracing a little bit and be able to jump out of the hedge and get back into it. But
yeah, that's something I talked to him about a lot. Was like, he and I were sitting there talking, and he was like, the reason I got out is because I sort of broke from the rules of trading, and it was I looked at my P&L, and I stopped, and that emotional hit when I saw I had lost 300 grand in the span of like an hour, that sucked. And I had to, I freaked out, and so I had to get out of the position. And I was like, well, how do you mitigate that? And he's like, it's you got to get control of your emotions. But I'm like, can you get control when you're trading? He's trading about $1 million account right now. Can you get control of your emotions enough, or even should you have control to be able to hold on to a $300,000 loss in like an hour? It's like maybe mitigating the position size is the answer there. And I think it's an ongoing debate that he has in his head, and you can't argue with what he does because it's like, the guy's been tremendously successful. But at the same time, I think that's kind of what you're getting at. It's just like you can lessen the risk that's there and lessen the psychological toll that the trade is taking on you by throwing on that hedge, right?
Right. I mean, what he could have done is he probably wasn't looking at the tape. He wasn't seeing
right
stock paper coming in, orders coming in. Once he sees that in multiple names, that's when I would go to the XLF and hedge the entire book with XLF.
Right.
And I'm going to talk to him more about it if he listens to me.
Well, he said the other day, he was like, I think I'm going to start talking to Bryan a little more about this stuff. So
because you go. Here's the deal. He essentially bought all these options, and if he locked in with the XLF, all of a sudden he has this huge option position that he's locking in the position with the XLF. Now he effectively bought all these options with a huge amount of edge. Now it's a vol position.
Right.
And the key with volatility trading, like when you're in the pit or now it's, I'm not a market maker, so I don't have theoretical values. In my head I have a theoretical value in what I trade because I know what it should be at that moment in time, roughly. But he has effectively bought those options with 50 cents of edge or whatever it was in edge. He's locking it in, and he can withstand a big move because he locked in his position, and he's all good. Now, if we keep retracing back up, once he identifies that with the paper in the stock, he goes back to basics, reads the tape, and he sees people are coming back in to buy it up. One thing he could do is even add more to the position. You could double up, and all, he could actually decide to buy more options because he hedged everything. It's zero delta. Let's get long deltas, and if you keep going up, then take the actual hedge off, and he has all these other options. And maybe I shouldn't be telling him this because then he'll have a crazy position. But there's different ways.
I was like, I don't want to hear this kind of stuff, dude. I don't want to.
Yeah, I know.
Make the position bigger. Like, no.
Listen. He was right. He was right, though. He should have stayed in, and he should have made $2 million in this trade.
Right, but at the end of the day, and that's like
because I know he wants to go there. He wants to go there. He has to get there, and he's gonna be pissed if he doesn't. And he needs to see now. Now we learn. Now he's learned more what to do in those situations, and it's okay to change your position from a delta position to a vol position.
Right.
And it's something that it's you don't learn that overnight. Like I don't learn tape reading overnight. I don't learn market profiling overnight. It's something that you learn, and every time you use it, you learn more and more, and you know how your body and your mentality works with that new concept. And I'm discovering things with you guys, and I'm using that on my trading. And I found something new recently, and I'm going to use that, and I think that's going to make me a lot of money. I think that he is going to take this hedging process and realize, yeah, let's do that. It'd been awesome if he hedged the whole thing with the XLF, and all of a sudden the market just crashes crazy. You would have made more. He would have made millions and millions of dollars with that, because the stock goes from, like, say he hedged in BAC. The stock went from like 15 quarter, I think is when he got out. 15 quarter down to 14, and he hedged the whole thing. He's making a lot more money on this whole position because of the hedge.
Even though the options tank on him?
Because he's hedged. So the stock, he makes P&L and selling the stock at 15 quarter. Say all of a sudden the market crashes and BC goes down to 14. He made $1.25 on, all right, what did he have? He had 12,000 shares, 12,000 contracts times, say it was a 60 delta. So I can't do, I'm probably going to have brain fart right now, but he might have had like 600 and, say 700,000 shares to sell in BAC, and it goes down $1.25. You're making $1 million on that.
Right.
Well, not $1 million, but you get the drift. You're making like $850,000 on that because the stock tanked, and he still has the options. So you buy the stock back, and maybe we drift back up, and you have all these options that aren't worthless anymore. You have 1,200 options that might be worth 10 cents. That's another $120,000 or whatever. Right. So.
I mean, he's a beast, and I've heard so many people come in and say, like, I cannot believe that you were able to nail that call on the financials the way he did. I mean, he predicted that move from 3-4 weeks out. He was stalking it, and I've seen his plays. That's what's cool to see is, like, even though he is a tape reader, and I think if the tape is very in the moment, information coming in, he stalked that move, and his big trades are ones that he stalks, man. I mean, when he talks about sector rotations and sentiment and stuff like that, I mean, that's such a huge part to his methodology, because it's like he was just every day hunting this thing, and when he saw that move start to happen in the tape, that's when he built in. And yeah, I'm excited to see what happens, in the next 6 months, year with you, Pete, and him working together, and you teaching him a little bit of what you know, and and him teaching a little bit of what he knows to you. I mean, it's cool to see, like, two completely different mindsets, coming in and melding together.
Yeah, it's pretty interesting. It's exciting. It's nuclear, in fact.
Right.
We need to figure out the exact approach. But yeah, like, she just, like, memorizes the tape reading. Like, it's kind of like I would remember, like, say for instance, so we were talking earlier, and we used to have a Delta guy in the S&P pit in Chicago. We called him the Delta guy. He came through as the biggest customer, and you'd make a market, like, you want the 40, he maybe be the 40 Delta call, and these were all monthly, so whatever, like the D's 18 quarter call, and I'd be like 4.5 or whatever.
Right.
And my value was $4.50, and he would buy them for $5, and I'm like, oh, 50 cents a veg, this is great. So I sell them,
right.
I hedge it, we go up, it's a great trade because the vol's coming off. I like I say, sell call, buy stock, we go up, but he's making money on the delta, so it's like both people are winning,
right?
Like, and then at the end of the day, I have to keep hedging the whole way up. It's short gamma, but elegantly going up. His option goes from $5 to $7, and at the end of the day, he wants to sell them out because he doesn't want to hold overnight unless he thinks that we're going to drift up. He doesn't want the decay, and I'm like, all right, 6.5, 7.5. And he sells it to me for 6.5, and I get 50 cents of edge. So in and out, I make money, and he makes money. And
right, yeah, and that's
anyway, so that's like the two different worlds combining as well.
Right, and when we go around and we sort of like are always looking, for better commission rates and stuff like that, and Pete is, an animal when it comes to that stuff.
Animal.
Our flow is just incredibly valuable because Lucci is just he is I guess a little bit of what. I mean, it's just people. No one trades like him,
He's paper. He's the Delta guy.
Yeah,
Like, I
exactly.
always wonder when I see in the names that I trade, like, who is the guy that's trying buying 200 or selling 200? It's
Right.
guys like Lucci.
Right. And
He's
it's like, what
the
does he
Delta guy
know?
in BAC.
Yeah. What does this guy know that I don't know? Like, no, that's
Exactly.
got to be what's going through you guys' head when that happens. Yeah.
Yeah. You know?
So you have like started reading the tape, and people in our offices and stuff talk about you with like reverence, that you're like this like mystical, absurd trader. So what is it like kind of learning the tape as like a new skill set? What like, and specifically, what have you found is like the most difficult about it? What have you found that helps you the most to like learn to read the tape?
Right. Well, I mean, it's not like tape reading is new to me, in fact. I never really called it tape reading, but when I was in Simplex in Chicago,
Yeah.
I was like trading part-time. When I left the pit, I started grad school, so I wasn't like fully focused on trading, but I was learning equity trading, and so I would wondering if I should hedge or not, and so I would look at the tape. I would look at the tape. I'd look at the level twos, and you know, it, I would see that there's a big buy or a big bid, and then maybe I'd hedge it if I had to, or let it ride or whatever. But it's always something that was there, but I never really thought about it creating the momentum and me really taking it seriously, because then I was still using like I wanted to go a certain direction, and if it wasn't, I would be like I want it to go my way, and I would just be stubborn. But really, the tape showed me that I should hedge or not hedge or whatever,
Right.
So it is something that is important because there's market makers in stock, and then there's paper in the stock, and the market makers are only there for a little bit. They're looking to buy and sell, so they're going to move their markets based on paper in the stock as well. So you have to see the paper come in, and if you see a big bid and then sweeps on the stock, then you have to take that seriously. And then if you need to get long, you need a hedge or whatever, then you need to buy your stock. Or if you want it to go up, then don't hedge your position and you let it run. The problem is when you see, like in some names, you see a big bid and some sweeps. It goes up, and then all of a sudden there's another guy, and it brings it back down. And he's like trying to sell.
Right.
So you're in this like mini vacuum of like, is it going up? I think it's going up. Oh, now it's going down because some other guy's coming in. So you have to like calculate what the net delta is and see the pressure change. So maybe we keep bumping up into that guy that keeps selling. Is he still there? So I'm learning about looking to see if that guy is still there, but also thinking, is it might be just a market maker that wants to mess with me, that's trying to appear as if he is some guy with some flow that's trying to push the market down.
Maybe it's a poker game, man. The tape.
It's a poker game, and you got to think at 12 o'clock, is there really a guy there trying to do an order? Probably not. It might just be a market maker trying to mess with me, and so that's something Pete has been telling me to do, to like think about. It might be a market maker trying to appear as a guy with liquidity, something to do. Right. So it's the seasonality involved as well. So that's something I need to learn. But I mean,
what's helped you? What's like the best thing? Like you got guys, you got traders watching this right now, and it's like, what is the thing that you're going to tell them? Like, this is what I have focused on, and it's helped me to get better at it. You think? Because they were saying that you were reading Tesla, and they were like, Bryan read Tesla the other day for 20 minutes. He had a phenomenal read on that thing, and Tesla's not an easy tape to read. So it's clear that you're picking it up, right?
Right.
I mean, not that I know it's not new to you. I mean, but it's just like you're integrating it more into what you're doing, I guess.
Yeah, I mean, the thing about it is I look at the technicals too. I don't just look at the tape. I think because there's some BS in the tape,
right?
You have to look at technical things. Okay, so like so Tesla crashed on that Tuesday, and then Wednesday morning pre-market it was traded like 115 or whatever, but it opened up around 120, and I kept seeing some guy bidding for 2,500 lots and sweeps, and I could tell that it was real because it was 9:30 to 10:30. It was elegantly going up and bidding up. Every dollar he'd come back in, and so I realized that's real. But after 10:30, 11 o'clock, I mean, unless there is big sweep move as it keeps going up. It's kind of just choppy, and you can't take it as serious. But then I'll look at the technicals, like pivot points. I look at, and if it depends on the time of day again. But if a technical lines up with some guy in the paper in the stock, then I take it more serious. But
you're kind of looking
for
kind
of no man's land and nothing's really moving, and I don't see anything in the options as well, because that gives you a clue, then it's just market makers trying to appear as if they're paper in the stock, or people kind of just trading. Might be people with big size that are trying to trade 5,000 lots in Tesla, because generally it's in a choppy area, and there's some volatility, some realized volatility, where the thing is going to bounce around in this area, and it might be an area in these pivot points that I look at. That's one thing.
Do you find more manipulation around key technical areas, right? I mean, if I'm a market maker, I know the technical areas that are, the indicators that most of the retail world or whatever semi-professional world is looking at. So if I'm going to manipulate stuff, that's kind of the key time to do it, right? I mean, how do you deal with that? How do you filter for that?
Yeah, well, I mean, you got to have like a room, margin for error, right? You gotta know that, just because there's a resistance point that gets broken, it needs to sustain that a little bit higher for me to really want to get ballsy into it, or some kind of momentum that is led up there, But yeah, there might be, a technical that's broken, but then you hit like a whole number or something like that, and paper comes in. You constantly have to keep checking everything. So you have to check the tape. You have to make sure that there's room for it to move. You got to look at the profiling, the volume at price. I mean, I'm learning you have to use everything, and then look at the options and see if if there's paper in the option, if there's like a call buyer in the at the money, or kind of maybe like a 40 delta call. That's going to add more pressure and push the stock higher. You got to see consecutive things. You got to look at, you see what you have. You have options, you have volume profiling, you got technicals, and you got the tape. So you got to see everything align.
Yeah.
And then, I have no reason to fade it unless everyone's working against me. Everyone's trying to fade me out, which I highly doubt market makers are going to load up on every single variable possible, and then all of a sudden just drop the floor and everything just crashes.
Right. I think that's why you're like the great white hope in our office right now, dude. Because you've like what you just said. I mean, like the big things that you're gonna need. What was it? Tape reading, market profiling, technical. I can't remember what the other one was you just said. It's like you have
options.
Yeah, and oh yeah, obviously in the actual understanding of how the options move. I mean, you have like a deep background in basically all that stuff. As you start to work tape reading into it,
yeah,
you can see how things go.
Brings it back to basics. I love it. I love the concept of that, because there's always something missing. I mean, when I was at Trading Machines, I was always like, we need a stock guy. We need a stock guy. We got to know where the stock's going. And it was option companies generally. I mean, sure there are more now, but when I was in the pit, we never had like a forecaster in where the S&P was going. And Trading Machines, it was never like, it was always like stock guys or whatever. They're, day traders. They're all idiots. And I was like, you can't just, no, I mean, no, there's an expertise in that. And Lucci, I mean, he's not a day trader. He's more like a short-term investor, I would say. But there is a science to it, and you got to respect it, because the option prices are based upon the stock. So you have to respect the stock. You can't just be like, oh, it's just stock, whatever, we're just volatility. No, there's always a terminal price in the option. And in the best case scenario is I sold options and I hedged them, and we're expiring today on that price. So it's always something like, forecast what's going to happen this week. Forecast what's going to happen tomorrow. And that's something that's very important. So we'll bring it all together, then we can make the pot of gold at the end of the rainbow. We can make that happen, make it bigger.
Yep, yeah. I like that.
That's what we want.
I mean, we're almost. We might even get booted right now because we're 4:30. But give us. I love the pit stories. I mean, if you got a story, easily. What do you got? Floating on the top of your head from the pit.
Well,
the pit.
I was thinking about that while I was raking today. What I should talk about, and I mean, 9/11. The day after 9/11 was like the craziest day, but I'll leave that for another time. I mean,
Right.
when we're talking about correlations with about Lucci and selling XLF versus the BACL's positions,
Right.
there was one time, it was maybe like 2003 or 2004, and some guy kept wanting to sell some like 6 month out call in the S&P. Say it was like the 12 half call or something like that. And we make a market, it's like 7.5, 8.5, or whatever. So, and you could see on his face the broker, the big broker, Tim Hendricks, is like the big guy. He was this like big Irish fucker. Sorry for the F bomb. Guy. He didn't go to college. He just like from the salt of the earth, Chicago. Anyway, so he had this big order, and he sold everyone that was 7.5 bid, and he's like, "What's here?" And we're like, well, now what? Because it's like you bought all this volatility, you bought all this Vega 6 months out, and all of a sudden we're like, it's in the state the stock doesn't move, and all of a sudden we're 7.8, and he's like, he sells everyone, and I buy 50 of the first price, 50 of the second price, so now it's half a buck edge, now it's $1 edge, and we're hedging, and I'm talking to my guy, and I'm like, I think there's my position manager was my boss. He was upstairs, and we have a headset. And I'm like, I think he has a lot more to sell in September. And then he all of a sudden he sells like 6 halves. And he sells like, we have like $2 of edge. And I'm like, we had a guy in the Dow Jones that, well, first we had a guy in the SPX and at the SIBO. So right. I'm like, tell Rich to sell anything in September. So it doesn't matter what, because you got to sell. You gotta, it's just like Lucci's got to get rid of his deltas so he can sell XLF, anything highly correlated. So the right. SPX and the S&P. SPX expires to cash, so and the S&P expired to futures, so it's two different things, but effectively it doesn't matter when it's so far out. So we had Rick sell like a straddle like 50 cents below, and it was great. At this point, the SPX, which is down the road, they know about this trade that's happening at the Merc. So I'm like, tell Dave in the Dow Jones to sell anything he can. So Dow Jones is like a 78% correlation at the time or whatever. So I'm like, I never talk to this guy during the day, and I call up Dave like, sell anything you can in September, because there's like $3 of edge in this name, in this one option. So it's like, sell whatever you can against this, anything that's highly correlated, because eventually even though the volatility gets banged down that day,
right?
Eventually it'll settle out and come back up, and the Dow Jones sale is a great sale against it. So you got to sell anything that's correlated in order to capture edge, especially when it's so much edge in this one option right. that we got. But anyway, so at the end of the day, maybe I bought like 300 options with net edge of like $2.5. So it's like $75,000 in that we made on this one trade. Right. But you're selling like Dow Jones against it. You sell, it's a big mess. That's awesome. But we were there like until 6 in the evening, Chicago time, checking trades. You got to check the trades with the broker, because it's right. He's selling like 10,000 contracts, and you got to like sit there all night to make sure there's no out trades. Make sure everything's hedged. Right. So I've never been at the Merc until 6 o'clock at night checking trades, but we had to that day. It was crazy. It's crazy. So that's one thing. Like, but we captured the money because we hedged it with. We didn't. I mean, it's not. This is actually talking about hedging with another option in another product. But still, hedging is very. You don't have to just hedge in delta. You hedge in volatility. So right. Selling one thing against another, that's so far. The further out you go, the more even it is. The more you have time to trade out of these volatility positions, and that's what we did that day. Eventually over time, probably took a couple weeks to get out of it, but that's another example of how to hedge. So it's hedging risk. So Lucci only trades delta, so you just want to hedge his delta risk. Right. Once you have a volatility position on, you got to hedge your volatility by selling other things when you buy certain things. So. Right. I know it's very complicated. I did a lot of rambling. I didn't do the math well because I haven't done P&Ls in the S&P pit in a long time. Multiplier 250, blah blah, but no one really cares. But hedging whatever risk you have is the key to collecting edge, realizing the edge that you have, and going further in your trading.
Right. Yeah, I mean, and it'll be interesting to see what happens, man. Next 6 months, next year, between you, Pete, Lucci, Chaim's obviously in the mix, working with you guys.
Yeah,
It's gonna be cool to be an observer.
it's gonna be awesome.
Yeah, cool, man. All right, dude. Well, thanks for hopping on. I know you got plenty of more leaves to rake, and God knows what else you're gonna be doing.
I gotta go to Boston to get my suit fixed, so yeah, I gotta hop on a train now.
All right, cool, man. Well, thanks for hopping on, and I will talk to you offline, man.
All right, brother.
All right,
Take
man.
care.